my experience has been that, a lot of the sophisticated uninsured money is long gone before a bank is closed. And what's left are the people who can least afford to lose money. For example, homeowners associations, youth sports associations, religious organizations, and not-for-profit organizations. They're insured as single entities, and the coverage is only up to $250,000. And I have seen hundreds of these organizations with millions of dollars on deposit at a bank. And, imagine the shock if your nonprofit lost money at an insolvent bank because you believe the insurance limit applied to each member of the group and you were fully insured.
That was Lesylee Sullivan Hodge, a former bank closing specialist with the FDIC, and our guest today on Banking Bad, where we look at past financial crises, the lessons learned, and what we should be doing to prepare ourselves for the next crisis. My name is John Bavenzi, one of your three hosts for this series, along with Tom Weiss and David Walker. Today, David and I will talk with Lesylee about some of her experiences while at the FDIC, where she helped manage the closing of hundreds of failed banks, making sure insured depositors regained access to their money as quickly as possible, and helping uninsured customers retrieve as much of their money as circumstances allowed. We'll also talk with Lesylee about her brief foray into banking, where at Penn Square National Bank, she learned firsthand what can happen to a high-flying bank when booms turn to bust. Lesylee, welcome to the program. It's good to see you again.
Hello, John and Tom and Dave.
Lesylee, can you set the stage for the story? What's the background behind Penn Square Bank? What should we know about it? And where were you at the time?
Well, Penn Square Bank was located in Oklahoma City in Penn Square Mall and consisted of the main office and a motor bank. Opening in 1960, the bank's asset size remained under $60 million until the late 70s. I thought I wanted a career in banking, so I applied for a job at Penn Square Bank in hopes of working there during my college years. That was in September of 1978. I worked part-time in the bookkeeping department and later as a motor bank teller. The bank only had about 25 employees, but this was the start of the oil and gas boom years, and the bank began growing rapidly.
Can you explain a little how the bank grew rapidly compared to other banks? It seemed like Penn Square had much more rapid growth than most banks.
Yeah, so during the boom years, the bank worked hard to attract enough deposits to fund the rapid growth. Penn Square offered the highest deposit interest rates in the country. Jumbo CDs were earning close to 12% and would ratchet up even higher over the next few years. One day, I showed up for work, and there was a Rolls-Royce Silver Shadow 2 sitting in the bank's lobby. To help promote the bank's fundraising activities, the bank was offering a Rolls-Royce to anyone who deposited $1 million in the bank. The Rolls-Royce was in lieu of paying 6 months' interest. They had to knock a hole in the side of the building to get the car inside. If you only had $100,000 deposit, you would get a luxury golf cart.
Well, that certainly beats the toasters that most banks were giving out around that time when you opened a new account.
For sure. And by selling participations to other banks, including Continental Illinois, then the 10th largest bank in the country, Penn Square was able to raise more money to fund even more loans. And as business boomed, it was not unusual to see helicopters land on the mall's parking lot, as helicopters were the preferred method for transporting those big city bankers out to the oil fields in western Oklahoma. And one of my assignments was to demonstrate to skeptical customers how to use an automated teller machine. The bank purchased its first ATM in 1980, and it was named the Beep machine after the bank's chairman, Beep Jennings. The ATM did beep when you touched it, and to encourage its use, random $20 bills were placed in the $10 bill slot, and random $50 bills were placed in the $20 bill slot. Lines started forming at the beat machine once word got out that it was randomly dispensing big bills. Some customers let us know that they were given too much money, but others never said a word.
So, Lesylee, when did you start to realize that the bank might not be as well off as it appeared?
In May of 1982, I graduated college and started a new position as a financial analyst in the recently established Loan Administration Department. Penn Square Bank's assets had surged to over $500 million at the time, and my job was to review the financial statements of current and potential borrowers to determine if they had the capacity to repay their loans. I thought it was strange that I had little work to do, even though the bank was growing rapidly. Even stranger, more than once, I was asked to review the financial statements of companies whose loans had already been funded. Obviously, that's not the way it's supposed to work, and it didn't take long after that for everything to fall apart. By late June, news began to circulate that the bank was having financial difficulties. The American Banker, the Wall Street Journal, and local newspapers ran stories about the bank's financial difficulties. These articles caused a full-scale deposit run on Saturday, July 3rd, and the bank soon ran out of cash. And on the evening of May 5th, 1982, the OCC declared Penn Square Bank insolvent, closed the bank, and appointed the FDIC as receiver. Bank employees were asked to report to the main office by 8 a.m. the next morning.
So, Lesylee, prior to Penn Square's closing, the FDIC generally handled a failed bank by selling it to a healthy bank. And by doing that, it protected all the bank's depositors against any losses, whether they were insured or uninsured. And it also protected the acquiring bank from any losses from legal actions taken against the failed bank. So if the failed bank had screwed something up and they got sued, the acquiring bank wouldn't have to bear those costs. But in this case, it wasn't sold to a healthy bank. The bank was just shut down. And the uninsured deposits were left unprotected. That created a huge outcry from the local community and from the bank's uninsured depositors. Can you tell us why the FDIC handled the failure this way?
So, John, there was no choice. As you know, by law, the FDIC can't protect all depositors by arranging a merger with a healthy bank if just closing the bank and only paying the insured depositors is a less costly alternative. Generally, a merger was less costly, but the acquiring bank usually paid a premium to the FDIC to acquire additional deposits and could manage a failed bank's loan portfolio more effectively than if the FDIC had to liquidate those assets. But in this case, because Penn Square had sold $2 billion in loans to other banks and had issued $1 billion in loan commitments and standby letters of credit, the potential cost to the FDIC to indemnify an acquiring institution was enormous. And the banks that had purchased those poor quality loans, they could seek reimbursement for their losses and could initiate legal action against the receivership, claiming misrepresentation on the part of Penn Square. And under a deposit payout, those legal claims become subordinate to depositor claims, which generally means they become worthless. In this case, that represented a substantial savings to the FDIC and making an insured deposit payoff necessary. The large volume of uninsured deposits only added to the cost differential between those two alternatives.
So an insured deposit payoff was the legally required resolution method. How did it work in this case?
Because the bank run, there was no time to prepare in advance. And the FDIC set up a Deposit Insurance National Bank of Oklahoma City, which is a newly chartered national bank that would remain in existence long enough to pay to customers their insured deposits. So on Monday evening, Mike Newton, who's the FDIC official in charge, explained to us what happened over the weekend and what the bank's former employees and FDIC staff needed to do in the coming week and thereafter. The clear priority, as I remember, was to focus on paying customers their insured deposits as soon as possible. And some of the bank's tellers recognized that their services may not be needed for long, and they quit on the spot. Paying these depositors was complicated by the number of unprocessed deposits and withdrawals from the long holiday weekend. So all of the work, the teller work that happened Friday afternoon, all day Saturday, wasn't being processed till Tuesday morning. So we didn't know exactly how much money was still in each account. It was a best guess effort. Some business owners took advantage of this chaos by having one authorized account holder get in line and withdraw all the insured money in that account, and then have another authorized signer of the same account do the same thing before that first withdrawal could be processed. And these overpayments were eventually recovered.
What about the uninsured depositors and other customers without deposit insurance? How did they fare in this process?
Oh my. Over half of Penn Square's $465 million in deposits was uninsured. And these depositors were issued receiver certificates, which are formal documents recognizing the holder's claim against the receivership. And businesses that had provided goods and services to Penn Square and had not been paid, they also had to file claims and were given receiver certificates when their claims were proven. And overall, the Penn Square receivership issued over 2,600 receivership certificates, totaling about $430 million to uninsured depositors and other creditors, which I think IndyMac probably had more, John, but 2,600 generating and producing and proving these manually, that was huge back then. But the approved creditors eventually were paid 75% of their claim, but they had to wait 14 years to get that amount. And in some cases, I recall that there were a lot of banks and credit unions that lost money. It's hard to feel sorry for them. They should have known better, but greed got the best of them.
Why did it take so long to get money back to uninsured depositors?
Well, in years prior to Penn Square, bank failures weren't that common. So the FDIC just let people who had loans with failed banks pay the money back over time. And afterwards, when hundreds of banks were failing every year, the FDIC had to become more aggressive in marketing assets faster and closing receiverships sooner. Today, uninsured depositors get back their share of money much faster than before.
Were very many other banks affected by Penn Square's closing?
Oh, yeah, in two different ways. First, there were about 150 credit unions and 20 savings and loans that collectively had over $50 million in Penn Square that was not insured. CD rates were in the high teens, and Penn Square paid higher rates than anyone. So money flowed into the bank from all over the country. And as FDIC Chairman Isaac later stated, let me quote here, nearly 80% of the uninsured deposits came from out-of-state institutions, including the credit union owned by employees of the United States House of Representatives, because they were greedy for high interest returns paid by Penn Square Bank. The, quote, shoddiest, unquote, banks almost invariably pay the highest rates on deposits. Secondly, and more significantly, there were very large financial institutions that had been snapping up loan participations from Penn Square Bank as fast as they could. When the bank closed, its total assets were approximately $500 million. But as I mentioned earlier, it also has sold over $2 billion in loan participations and issued $1 billion in standby letters of credit. These participating banks paid origination fees to Penn Square so they could fund a portion of the loans and share in the expected returns. And then after Penn Square Bank's failure, These bankers from Continental Illinois, Michigan National, Chase Manhattan, Northern Trust, Seattle First, and Hibernia started reviewing the documentation on their loans, and their grumbling began almost immediately. Where's a copy of the note? You mean I purchased a $2 million participation and the note is not even signed by the borrower? Where's the financial statement? Where's the signed loan guarantee? The documentation shows a letter of credit that is secured by an unsecured letter of credit as collateral. How can that be? I remember prior to Penn Square's closing, these banks were visited Oklahoma City regularly and couldn't purchase loans fast enough, and never once raised an issue about the supporting documentation. And years later, Chairman Jennings listed several so-called myths that seemed to evolve out of the Penn Square story. And he said, and I quote, "The one that sticks in my craw more than anything is the idea that large upstream banks and money centers were conned into buying loans from Penn Square. On the contrary, they solicited such loans and were partners in improving and taking these loans."
Well, that's very interesting. We've seen that before when bankers rush to list products and forget about documentation, and it doesn't seem like a big priority at the time. So deja vu all over again. Lesylee, what happened to these upstream banks that did this?
Well, Steve First was acquired by Bank of America after posting huge losses from its Penn Square loans. Michigan National experienced operational issues and underwent a huge reorganization. And of course, there was Continental Illinois, which was the source of the phrase "too big to fail" after it had to be rescued by the FDIC.
Lesylee, what did you do next after your work with the FDIC at Penn Square was finished?
Well, technically, I was employed for 2 months by the Depositors National Bank. And during that time, I applied for a 1-year term position with the FDIC and was hired as a liquidation assistant. And after that, there was a whirlwind of activity. Banks started failing. And I attended my first bank closing as an FDIC employee, which was a deposit payout in Lovell, Wyoming. The following week, I traveled with the closing team for a payout at a small bank in Las Vegas. After a week, we returned to Wyoming, but a potential payout popped up in Illinois, so we packed up and flew to Chicago. I had packed for a 1-week trip, but was gone for 5 weeks. And over my career, I was transferred 9 times to 5 states and closed hundreds of banks in 25 different states. And I have no idea how I morphed from a person who preferred order in her life to a person who thrived in chaos.
Well, I know a lot of your colleagues, Lesylee, had the same experience. They and their families had to sort of uproot themselves multiple times to move to wherever the bank failures were at that point in time. And, during the 80s, it was a period of sort of regional recessions and bank failures. So it was going from one part of the country to another. It's one of those things that, that the public never hears about, but it's part of you and many others' dedication to, getting things done.
My family owned a trucking business in Oklahoma, and my mom oversaw the books. And during the 80s, she became very cautious about when she deposited checks into the local banks. Some days these deposits were quite large, and it would have been devastating to the business if the bank failed and left them with uninsured funds. So for peace of mind, my mom only made deposits on Mondays, Tuesdays, and Wednesdays, since insolvent banks were usually closed on Fridays.
Wow. So you must have experienced some pretty difficult situations then.
I have. And my experience has been that a lot of the sophisticated uninsured money is long gone before a bank is closed. And what's left are the people who can least afford to lose money. Most people don't understand the deposit insurance rules. And time after time, we encounter depositors who believe they're fully insured when they aren't. And that leads to some very unfortunate situations. For example, homeowners associations, youth sports associations, religious organizations, and not-for-profit organizations. They're insured as single entities, and the coverage is only up to $250,000. And I have seen hundreds of these organizations with millions of dollars on deposit at a bank. And, imagine the shock if your nonprofit lost money at an insolvent bank because you believe the insurance limit applied to each member of the group and you were fully insured.
Continuing on, like in recent years, we've seen in situations like with Silicon Valley Bank that even the so-called sophisticated money can be pretty unsophisticated when it comes to safeguarding their money. Lesylee, do you have any recommendations to legislators, regulators, banking examiners, industry, or the customers on these issues?
Sure. For bankers, if you don't already know, you need to learn the basics of deposit insurance. Too many times I've heard depositors at failed banks tell me that their banker told them their money was fully insured when it wasn't. And most, but not all of the time, the bank staff is trying to do the right thing and it's an honest mistake. I recall at one bank closing in Metropolis, Illinois, there were a lot of uninsured depositors, and the bank's cashier asked about the number of uninsured and almost fainted when we gave him the news. It took him a few minutes to compose himself, and he asked for a list of the uninsured depositors and the amounts. And he was honestly shocked at the uninsured information because he's the one that opened these accounts. Then he did something that I had never experienced before. He asked if we would bring the depositors to his office because he wanted to apologize to each of them, and he did. And the affected depositors were gracious. No one blamed him. And I witnessed the definition of integrity with that gentleman, and it touched me deeply. Because usually the bank employees who are responsible for opening accounts, they're usually nowhere to be found. To this day, I remember how I felt having to relay bad news to a depositor. She was a widow with young children, and her husband had died tragically a few months before Penn Square failed. The proceeds of his life insurance, it was probably close to about $1 million, was deposited by an attorney into Penn Square Bank in the name of his estate. However, the account only qualified for $100,000 in deposit insurance. She was able to recover the same 75% over 14 years as did others. And thinking about her situation made me determined to better educate people on deposit insurance coverage.
That's a big issue in deposit insurance right now about insuring these, they call them temporary high balances. It's now the rule in Europe. The Europeans have adopted it. It's life insurance. It could be commuted value of a pension when someone retires. They're very rare, but they're shocking.
We see time and time again that it's people who've temporarily put money in a bank over insurance limit and so forth. And if there's actually conversation about protecting such accounts, that would be a really positive thing.
We've had, I don't remember which bank, but somebody had just sold their house and the proceeds went into the title company's escrow account. Well, we insured, passed through insurance to that homeowner who had sold their home. But it was like a couple of $1 million, and they got like 100. Those kinds of things that it's heart-wrenching.
Yeah. I mean, what should bank customers be? I mean, it'd be great if the laws were adjusted to protect that temporary money. But in the interim, what should bank customers be doing to better protect themselves?
Well, for bank customers, it is ultimately your responsibility to ensure your deposit accounts are established as you intend them to be. And I believe people trust their bankers too much, so they don't bother learning the rules. And the worst time to learn that your accounts are not set up as you intended is when your bank fails. And it is also the depositor's responsibility to periodically check the styling on your accounts, especially after a rollover, or if one of the account holders has passed, the ownership of that account changes. So, the FDIC's insurance determinations are based on the bank's records, not on the intentions of the depositor. And, in a perfect world, those two would match. And over the years, the FDIC recognized a need and developed two programs designed to help people enhance their financial skills and, hopefully create a positive banking experience. The Money Smart program was started over 25 years ago, and it provides financial tools for a wide range of age groups. And the training materials are provided by the FDIC and are available in English and Spanish. Then, what I deal with a lot is a program that was released in 1998. It's called the Electronic Deposit Insurance Estimator. We nicknamed it EDI. And it lets consumers and bankers know how the insurance rules and limits apply to a depositor's specific accounts. EDI calculates what's insured and what's uninsured, if any, at a particular bank. And, EDI also allows the user to print a report for their records. So depositors out there, if you're thinking of depositing more than $250,000 in the bank, you can take along the EDI report and to confirm your banker establishes your accounts correctly. And I've had a situation where, the depositor has said, the bank told me this is how I'm supposed to set up my accounts. So now you're telling me I'm uninsured. I sat with that depositor and we input everything into EDI to show that he was uninsured. And then we changed it up so that he would be insured. And he took those printouts to his new bank to test the bank employee to see if they would set his accounts up correctly. And they didn't. So he went to another bank.
It's really good to hear that you can catch some of these things in advance and fix them before they turn into a problem. What would you say to legislators or bank regulators? What do they need to be thinking about besides, just the bankers and the bank customers themselves?
So, in my opinion, I feel that safeguards need to be put in place to protect unsuspecting customers from the wave of these new financial products like Bitcoin, fintech. It seems that whenever there's a new get-rich-quick scheme or product, there are wannabe bankers out there who jump on it, hoping to make a lot of money, then sell the bank for a big profit. When in reality, they get in over their heads, the bank fails, and depositors suffer the consequences. And recently, entrepreneurs have been buying small rural banks, buying the charter, then moving that charter to a big city, changing its name to something catchy, and then diving into the latest scheme to start making big money. And to me, this sounds like what the scammers in Texas did with the savings and loans back in the 1980s.
Yeah, we'll probably have a podcast soon on the S&L situation and what happened then. But yeah, there were so many people who just went into and were able to buy S&Ls and fund their own businesses and get rich quick schemes. Hopefully we're not seeing that again. Lesylee, in our first episode of Banking Bad, we talked about the First National Bank of Keystone. And I know you were there for Keystone's closing and saw firsthand, the hardship that was created by that bank's failure. You were a little bit like that banker who wanted to talk to the uninsured depositors. You were so moved by the people you met there that you went back to Keystone, West Virginia, some 20 years later. Before we close, can you just tell us a little bit about why you went back and what it was like?
So, John, in that episode, you mentioned you did a recap of Keystone, West Virginia. It's a town of 450 people. is located in a holler in the mountains of southern West Virginia, and it was really close to the Virginia border. And my first impression of Keystone, as I was driving in, was I could not wrap my head around there being a bank in that town with over $1 billion in assets. It was immediately obvious that the town was decades past its heyday. The townspeople were friendly but cautious when confronted by over 50 feds invading their town. Keystone was unique in that the bank closed, I believe it was on a Wednesday I don't think they were even allowed to open on that September 1st. And usually the FDIC, we get financial information, depositor information before a bank closes. So we know going in how many uninsured depositors we have and what the amount of the uninsured is. But with Keystone, since it closed immediately after discovery of the fraud, we had no information on any of the depositors when we drove into town. And I don't recall specifically how many townspeople were uninsured, but one would have been too many. The depositors we interviewed were salt-of-the-earth types who had worked hard for their money and had few, if any, luxury items. We didn't see one foreign car in this town. They were all American-made. Most of these depositors were 60 and older, and we took Labor Day weekend to determine what was insured, what was uninsured, and it ended up, as I recall, being about 75 to 100 individuals, businesses, and nonprofit organizations had funds exceeding the $100,000 insurance limit. And this didn't include any of the broker deposits that they'd had. That was a totally separate production. So over the next 2 weeks, the claims team interviewed each depositor, and almost every single one of them said they had relied on bank staff on how to structure their accounts. So, we had our initial determination. The information they gave us wasn't helpful. We couldn't use it. It didn't matter. So we had very few changes to the number of uninsured depositors. And delivering bad news 8 hours a day was gut-wrenching. And in most closing resolutions with uninsured deposits, the failed bank's assets are liquidated, over time, and uninsured depositors receive a portion of their uninsured funds, over time, and eventually recover about 70% on average. So, adding insult to injury, due to the massive fraud and questionable valuation of Keystone's assets, it was doubtful that these uninsured depositors would ever recover a penny of their uninsured funds. So the claims team had to pass along this bad news as well. So, to add to some drama here, we met with depositors, gave them the bad news, and a lot of them took their deposit insurance check to a different county. There were issues with the acquiring institution. So they took their deposit insurance check to another county, opened a bank. I'm sorry, I get emotional over this.
Yeah, I know this is tough.
They went to another bank, started opening accounts. Well, we noticed on our schedule of appointments that people we had already talked to were making second appointments. So when we met with them, they said that an officer at this new bank had told these Keystone depositors that FDIC had miscalculated their insurance coverage and they were due more money. So that's why they came back to talk to us. So they were just so hopeful that we had made a mistake. And unfortunately, our calculations were correct. And I believe it was FDIC Consumer Affairs immediately sent a team to the county to do deposit insurance training, which hopefully was, I'm sure that was very helpful. these Keystone residents realized the FDIC staff were going to be there for a while. And, we began to feel accepted. The nearest restaurant was 20 minutes away. So the high school booster club brought in a concession stand and sold hot dogs, hamburgers, fries, sodas to us hungry liquidators. And, everybody rounded up their tab, just because it was the booster club and, they really needed some new equipment at the high school. And we also, the FDIC staff took up a collection for gym clothes for the high school students. They didn't have separate clothes to wear during gym. They were wearing their regular clothes. So we raised enough money so that every high school student could buy gym clothes, and plus enough to rent a bus to take the students to the JCPenney and Bluefield to select their own clothing. So, many of the students had never even been out of McDowell County. So the trip was exciting for them. Over the years, I received calls, Christmas cards from some of these uninsured depositors. And most of the callers, were wondering if they were ever going to get a dividend. Originally we had told them they would probably never collect anything, but the First National Bank of Keystone receivership paid its first dividend of 37% in November 2011, 12 years after the bank failed. A final dividend of 4% was paid in November of 2018. So over 19 years, all they recovered was 41% of their original claim. And that was one of the lowest recoveries ever. Usually the average recovery is about 70%. So way below average. If fast forward to 2019, there were a few of us claims agents. We remained friends, and we were reminiscing about our time in Keystone. And of all the closed banks I was a part of, the Keystone closing affected me the most. And my fellow claim agents, they felt the same. So we returned to see how the town had fared over the past 20 years. The population had dropped to 175 people, and there was not much going on. The bank was still there. They had their sign, time tried, panic tested. It was, we met the mayor and a few other townspeople that were out and about, and several of them remembered the FDIC invasion of their town, and emotionally we were conflicted because we recalled the long work days, the drive up and out of the holler, and hour there, hour back, and just the stress of delivering bad news. But we all recalled the friendliness of the townspeople, and the people of Keystone, West Virginia will always have a place in my heart.
Lesylee, I really want to thank you for being here with us today. I know that was a hard story to tell and reminisce about, but I'm sure our audience is going to get a feel for what it was really like in some of these situations and how important it is for everyone to hear there are dedicated government employees like yourself who have worked, to help as many people as possible get their money back as quickly as they can. Just to wrap up and, to put this in some perspective, in, the United States, we've become used to the fact that when a bank's closed on a Friday, people get their money back almost immediately. It's become commonplace, and it's been that way for years because of you and your colleagues who've worked so hard. But it's not as easy as it sounds. You've explained how the rules are complicated and banks don't always have the right records. And, the FDIC does have automated systems which help segregate insured from uninsured deposits, and they use personal identifiers, names, address, and so forth, and put in types of account like you're talking about with the ED program. But those automated systems are only as good as the data that gets input into them. And with failed banks, the data aren't always perfect. So given those difficulties, the speed with which the FDIC does return funds, it's worth spending this time to recognize. There's the International Association of Deposit Insurers that's really the global standard-setting body for deposit insurers around the world. And they've set, a goal of insurers being able to get the money back in 7 days. And that's an ambitious goal for countries around the world. And there are a great many who can't, meet that goal, but all are striving to get there. And a lot of progress has been made all around the world. With so many people living paycheck to paycheck, getting quick access to their money really, really matters. And so I do want to, thank you again for being here today with our audience, Lesylee. And that concludes our discussion for today. And for all of you listening, thank you. And I hope you join us for our next episode of Banking Bad.